Although we've used, as an example, $2,000 invested in your IRA each year, the wealth building effect of up to $7,000 invested yearly in your 401k, 403b, or other employment-related retirement plans is much greater. Look over the Power of Tax-Free Compounding chart in your manual, and you'll see how your retirement plan will build your fortune over the next 5 to 30 years.
Strategy 4-38. Contribute to your retirement plan now. Don't wait until later.
You can't be too young to start a retirement plan. Listen to the next statement carefully. It will amaze you. If you invest $2,000 in a tax-deferred retirement account each year between the ages of 20 and 26 and never invest another cent, you'll have more money when you reach age 65 than if you wait until you're 26 and invest $2,000 every year for 40 years without the tax protection.
Strategy 4-39. Choose an IRA with a low trustee's fee.
Every IRA must have a trustee. That's someone certified by the IRS to be responsible for your account. If you put your IRA money in a bank, mutual fund, credit union, or other financial institution, you automatically use the institution's trustee. The required paperwork involved with your IRA is considerable, and therefore most all institutions or trustees charge an annual fee. That's because they do the paperwork. The fee can range from $5 to hundreds of dollars and is not deductible unless it is part of your $2,000 contribution limits. Avoid all accounts that charge a percentage. The percentage may seem small when your account is small, but it will amount to hundreds per year as your account grows. You probably won't even see it happening. Many major brokerage firms and financial planners do charge a percentage.
Strategy 4-40. Borrow the money for your IRA even if you have it.
The tax and investment advantages of an IRA are so powerful that if you borrow the money for your account, you'll end up borrowing the money free. Let me explain. Let's say that this year you're a little short of cash and borrow $2,000 from the credit union or bank for your IRA. The interest at 12% for 1 year would be $240. If you're in the 28% tax bracket, however, the government will refund you 28% of your $2,000 contribution, or $560. The $560 not only pays the $240 interest, but gives you an additional $320 profit. Not a bad day's work. Consider borrowing the money for your IRA even if you have it, so you can keep your money invested elsewhere.
Strategy 4-41. Use your retirement plan as an instant source of borrowed capital.
If you have a 401k or 403b, your money is not tied up until retirement if your company offers the IRS-approved loan provision. The rule states that you may borrow up to 50% of the vested amount of your account, not to exceed a total of $50,000. The loan must be paid off within 5 years with no less than quarterly equal payments, which means 5% of the principal paid quarterly. The payback rule is waived if you use the money as a down payment on a principal residence. Loans are not made out of the self-directed investment portion of your account, so you must first move your money to the fixed rate account in order to borrow it. If you borrow $10,000 from your plan, you earn interest on the money in the fixed rate account and pay a slightly higher interest rate on the money borrowed. That money you borrow is considered money borrowed from the general fund. 65% of 401k plans and almost all 403b plans now offer the loan provision. It is up to your employer.
Strategy 4-42. Use the loan provision of your 401k or 403b to borrow the money for an IRA.
If you qualify for an IRA because your adjusted gross income falls below the IRA exclusion limits, borrow the $2,000 or $4,000 to fund an IRA for you and your spouse from your 401k or 403b retirement account. Even though you used borrowed money to fund the IRA, you have reduced your taxable income and your taxes. If your tax bracket is 33%, you will save $1,320 in taxes on a $4,000 IRA contribution simply by shifting the money from one retirement plan to the IRA. The interest you pay on the borrowed money is tax deductible if the loan is secured by your employer's contribution, but not if secured by your contribution. That's something you handle with the department that makes the loan. Now let's look at your investment options, one of the most important parts of your retirement plan.
Strategy 4-43. Open a self-directed IRA to earn 20% per year.
The four worst choices for an IRA investment are, guess what? Banks, savings and loans, insurance companies, and credit unions. They don't want to pay enough interest to keep you interested. A return of 7% to 10% is not an investment, but only a savings plan, even if it is tax sheltered. One of the major benefits of an IRA, and often the least used, is the ability to choose your investments through a self-directed account. Anyone who qualifies for an IRA may open a self-directed account. A self-directed IRA puts you in control, letting you choose any investment you wish, such as stocks, bonds, mutual funds, discounted mortgages, real estate options, county tax lien certificates, mortgage pools, or even, believe it or not, the lot next door to your home. Every IRA must have a trustee. Financial institutions such as brokerage firms or mutual fund families have one trustee for all IRAs, but you can choose only the investments that that financial institution sells. If you want to invest your money in real estate, discounted mortgages, or tax certificates, you must find an independent trustee. Any bank trust department can legally act as your independent trustee, but many won't. There are now a few financial planners who are IRS-registered independent trustees. Finding an independent trustee may require some extra effort, but is worth the time if you want your IRA in non-traditional investments.
Strategy 4-44. Never invest your IRA in a tax shelter.
An IRA is already a tax-sheltered investment. Since you can't take the deduction twice, avoid tax-sheltered investments, which are usually more restrictive. For many years, some brokers and financial planners have incorrectly advised clients to put IRA accounts in tax shelters like real estate limited partnerships.
Strategy 4-45. Use the switching rules to earn 20% in your employer's retirement plan.
The tax rules allow you to change investments within a retirement plan or an IRA anytime you wish. The limits to the number of changes per year are set by your employer or the financial institution in which your IRA is invested. Let's look at the IRA switching rules first. If your IRA is in a self-directed account at a mutual fund family or brokerage firm, you may move your money from one investment to another within the same institution as often as you wish. To move from a stock fund to a money market fund, for instance, you would simply contact the person or company handling your account and request the move. There are no penalties, and the processing charge should be no more than $5, if any. Now for the IRA transfer and rollover rules. If you're dissatisfied with the performance of your IRA and you want to transfer the money to a new IRA in a different institution, such as a mutual fund family, you have two options. First, the trustee-to-trustee transfer. By signing a transfer agreement with a new trustee or institution, the transfer of your IRA can be handled by the two institutions. There's no limit to the number of transfers which can be made each year using this method. Second, the IRA rollover. You may physically withdraw your IRA money and open a new IRA with a different institution with no tax penalty, as long as the money is redeposited within 60 days exactly after the date of withdrawal. During the 60 days, you may do anything you wish with your IRA money. You may do a rollover no more than once per 365 days. The 401k, 403b, and SEP switching rules. 90% of all employment-related retirement plans now give you options for investing. Your investment alternatives are actually mutual funds offered through mutual fund families or insurance companies chosen by your employer as sponsors of your retirement plan. The choices for your retirement money are two or more of the following. Refer to the Employer Retirement Plan Investment Options chart in your manual. The actual name of one of your investment options is the stock fund. This is what may be called in your retirement plan the equity or variable fund, and the salesman may call it a high-risk fund. The bond fund is also called a bond fund in your retirement plan, but could also be known as the government securities fund. The salesman may call that a medium risk investment. Now, there may also be a stock and bond fund option, which the retirement plan may call the balance fund. Salesman will refer to it as medium risk. There will either be a money market fund or a fixed rate investment option, or both. The retirement plan often calls the money market fund the variable investment or the fixed rate investment the guaranteed return. The salesman will refer to either one as low risk. Of course, if you work for a corporation, one of your options may be company stock, which will be referred to in your retirement plan as company stock. The fixed rate and company stock investments are the only options that are technically not mutual funds. The fixed rate investment pays a guaranteed interest rate without the potential for capital appreciation or increased earnings. Company stock is usually offered to employees at a discount, usually 15%, and often must be held until termination or retirement. The 15% discount is attractive as long as there is an option for selling the stock within a couple of years and moving to another investment. The risk factor terms used by salesmen and the sales materials are 20 years out of date and certainly not applicable to anyone using these strategies and should be ignored. Although corporations usually offer only one plan or sponsor with several investment options, some school systems, like Orange County, Florida, offer over 50 different plan sponsors. If you're employed by a company that offers more than one plan sponsor and you become dissatisfied with the plan, you may transfer all of your account to a new plan sponsor based on the rules of your plan. In many plans, if you change sponsors or withdraw your money during the first 5 years, you would or could be charged a back-end load or commission. The money movement strategy is a formula for switching between the three different types of mutual funds, stock, bond, and money market, to catch only the upcycles of each type of investment, and should be used with mutual funds in a self-directed retirement plan. Let's look closely at your withdrawal options. Beginning in 1988, you cannot withdraw any money from your employer-related retirement plan except for, number 1, death, 2, disability, 3, financial hardships, 4, termination of employment, such as changing jobs, or number 5, retirement. You may withdraw any amount before the end of 1988 from any employer plan. Financial hardship is determined by your employer based on IRS guidelines, and the application of the rules varies widely from employer to employer. Borrowing money from a retirement plan is not considered a withdrawal. You can withdraw money from your IRA anytime you wish. If the withdrawal is made before age 59 and a half, there is a 10% additional government penalty imposed on the amount withdrawn unless the withdrawal was made because of, number 1, death, number 2, disability, or number 3, life expectancy payout. Life expectancy payout means you agree to withdraw your IRA money in monthly payments based on the IRS mortality table. That's a set of figures published by IRS. You can get one by contacting them. Using this method, you can increase your spendable income through periodic withdrawals from your IRA with no 10% penalty, even before age 59 and a half. Sooner or later, you'll stop contributing and start withdrawing and enjoying the money you've accumulated in your retirement plan. That's why you set it up in the first place. If you followed the strategies as outlined, your retirement accounts will provide you with luxurious living for the balance of your life instead of only an income supplement. How you plan your withdrawals is as important to your wealth as how you planned your contributions and investments. I'm now going to describe your withdrawal options when you retire or change jobs and which are the most beneficial or detrimental to your wealth. There are several rules that apply to withdrawing money from all retirement plans, which we will look at first. Let's look at the withdrawals you make before age 59 and a half. Under tax reform, there is a 10% automatic, non-deductible tax penalty for premature withdrawals from any retirement plan for reasons other than disability or money transferred to an estate because of death. As always, there are exceptions even to these rules. First, if you retire early, but after you are 55, you're allowed to withdraw your money with no penalty. Second, if a court orders you to pay money to a spouse or child from your retirement account, the withdrawal is not subject to the penalty. Third, if you have extraordinary medical expenses, withdrawals used to pay the medical expenses are not subject to penalties. Fourth, a premature withdrawal plan available to IRA participants is the annuity option. By agreeing to take, as we said before, the withdrawal as a series of periodic payments over your expected lifetime based on IRS published mortality tables, you can avoid the penalty. Fifth, if you withdraw money from an employee stock ownership plan, an ESOP, before 1990, that on the average has been invested for 5 years or more when you withdraw, there is no penalty. Sixth, there is no penalty for the withdrawal of dividends from an ESOP plan. Now, let's look at the withdrawals after your age 59 and a half. There is no 10% penalty applied on a withdrawal after age 59 and a half, no matter what the reason or method of withdrawal. The method you choose, however, for your withdrawal will determine the amount of taxes you pay.
Strategy 4-46. Use the lump sum averaging method only if you need the cash from your retirement plan.
If money is withdrawn in a lump sum from a retirement plan, the averaging method option reduces your taxes to a minimum. The averaging method allows you to treat your lump sum distribution as if you received an equal portion of the distribution each year for 5 or 10 years. Those who are over 50 years old on January 1st, 1986 may elect 10-year averaging at any age. Those under 50 on that date may use only 5-year averaging after age 59 and a half. Lump sum averaging may be used only once per lifetime. The old tax law allowed averaging every time a person changed jobs or retired, no matter what age. Now, averaging does not happen automatically. If you don't elect it, you could be liable for the full amount of taxes. The purpose of lump sum averaging is to prevent the distribution from putting you in a higher tax bracket. Because of the two tax bracket system under tax reform, the averaging method does not reduce taxes nearly as much as before tax reform and makes the rollover option far more attractive. If your employer's retirement plan qualifies you for lump sum averaging, it also qualifies for the tax-free rollover to an IRA.
Strategy 4-47. Use the IRA rollover rules to minimize the taxes on your employer's retirement plan lump sum distribution.
Now, when you change jobs or retire, your objective is to get control of your 401k, 403b, 457, or the SEP. The rollover rules allow you to move your entire company retirement plan to any IRA without the $2,000 IRA restriction. You request a check from your former employer for the amount in your account, and you have 60 days from the date you receive the money to deposit it in the new IRA. Since the rollover allows you to move your money without tax consequences, it is your best alternative for, number one, getting control of your retirement money, number two, keeping the money totally tax sheltered, and number three, greater earnings through self-directed investments.
Strategy 4-48. Open your rollover IRA in a no-load mutual fund family.
By using the money movement strategy with your rollover account, you will average 20% per year tax sheltered. If your rollover account is $200,000, you will average $40,000 per year and double your money in under 4 years.
Strategy 4-49. Avoid the employer-to-employer transfer of your retirement account.
When you change jobs, you have the option of moving your retirement plan from one employer to another with no tax consequences and preserve your right for lump sum averaging. The downside to this option is that your options for investing are limited to those in your new employer's plan. It's better to do the IRA rollover. You can usually continue to use a previous employer's plan for 1 year or more, but your strategy is to get control of the money, which makes this option undesirable.
Strategy 4-50, never annuitize your company retirement plan.
Instead of receiving a lump sum, many plans allow you to use your retirement money to buy a lifetime annuity contract from an insurance company. Based on life expectancy tables published by the insurance company, you receive monthly checks for the rest of your life. Another option allows you to take less now in your monthly check, which guarantees your spouse will receive monthly payments if you go first. Because of the built-in investor problems, the annuity option makes only the insurance companies wealthy and is the worst of the withdrawal options, even though it sounds the most appealing. There are three major problems. First, the insurance company annuity tables give you monthly checks that are far smaller than you should receive for an account that size. Second, your principal in most contracts becomes the property of the insurance company if you die. Your heirs don't get the money. Third, the monthly checks are based on an extremely low investment return on your principal, which is now owned by the insurance company. Let's look at the mandatory withdrawal rules. All retirement accounts, including qualified employer plans and IRAs and KEOs, now have a required uniform starting date for mandatory withdrawals. This withdrawal method is not optional, but a few strategies will enable you to minimize or eliminate the taxes on the mandatory withdrawal. You must start making your withdrawal from your retirement plans by April 1st of the year following the year you become 70 and a half years old. So actually you'd be 71 and a half. Until 1989, you can defer the withdrawal from any account except an IRA if you continue to work. The minimum yearly withdrawal amount is based on an IRS life expectancy table for you or your spouse. The rule of thumb is that your withdrawal will be about 10% of the money in your account.
Strategy 4-51, create additional tax deductions to shelter a retirement account withdrawal.
By using the tax strategies in the tax section of your financial library, you can create enough additional tax deductions to make a retirement account withdrawal tax-free. Your withdrawal is not directly taxed. The amount of the withdrawal is added to your income for the year and taxed at your highest bracket, for instance, 33%. Every $1,000 of new deductions you create through a small business, family tax strategies, travel deduction strategies, has the effect of sheltering $1,000 of your withdrawal. That's the power of your tax plan.
Strategy 4-52, to minimize a mandatory withdrawal, recalculate your life expectancy every 3 years.
The longer you live, the better your chances of living longer, according to the IRS life expectancy table. If you are 70 and a half, your life expectancy might be 10 years. But if you make it to age 75, it still might be 8 years. By recalculating your life expectancy about every 3 years, you keep the mandatory withdrawal percentage at a bare minimum. You're allowed to elect to use the new tables for a person your age anytime you wish. The tables are available from IRS. Strategies such as these and others you're learning are often overlooked by tax preparers and CPAs. So use this information as your retirement plan reference manual. It's all right to spend the money from your retirement account for pleasure. Withdraw all you want. That's why you put it in there in the first place. Too many successful retired people spend too much time trying to preserve capital instead of spending and enjoying it. You can't take it with you. So far as anyone has discovered, there's no way to attach a bank vault to a hearse.
Tax-sheltered mutual funds. Strategy 4-53, use a self-directed annuity to earn 20% per year with no commissions or taxes.
Self-directed annuity is a tax-sheltered investment in which you have a choice of 2 or more investments. There are 1,100 fixed interest rate annuities which have only one investment choice, a fixed interest account. but there are only about 10 self-directed annuities. A self-directed annuity is, in reality, a tax-sheltered mutual fund family. All 10 of the self-directed annuities offer you the same 3 choices as investments: stock mutual funds, bond mutual funds, and money market mutual funds. Because of the tax shelter feature, you can move your money from one fund to another within the same institution with no tax consequences. An annuity is technically a contract with an insurance company that requires you to pay money into the account now while you are still able, and requires the insurance company to pay you back in a lump sum or in monthly payments later in life. Like all great ideas, most people have little or no knowledge of the existence or use of self-directed annuities. Few brokers or financial planners will recommend self-directed annuities because of the low or no commissions paid on the initial investment. You may, in most annuities, withdraw 10% of your money each year for whatever purpose you wish without penalties or commissions, at least with no penalties or commissions from the insurance company. The first rule of annuities is to use them last, only after you have maxed out what you can legally put into your IRA, KEO, or other tax-sheltered employment-related retirement program. The money you invest in an IRA or KEO, remember, is tax-deductible. In an annuity, only the investment earnings are tax-deferred. You've already paid taxes on the money you invested, remember. Teachers and state employees' job-related tax-sheltered annuities are an exception. We're talking about non-employment-related annuities. You do not have to be employed to invest in a self-directed annuity, and you may invest a lump sum, called a single payment annuity, or in installments over any period of time. All of the self-directed annuities, which we'll talk about later, give you at least 3 to 5 choices for investing your money. When you open your account, tell the company which of their investments you have chosen. Never let them tell you. Once your money is invested in the annuity, you manage your money in the same way as you would in a mutual fund family, using the money movement strategy. Over 20% returns will result with no taxes. With the new tax laws, you must begin withdrawing about 10% of your money each year after you reach age 70 and a half. When you withdraw, you will be given options. Take the money out in a lump sum, or allow the account to annuitize. Annuitizing means the company will guarantee to pay you a monthly income over a specified number of years, or even for the rest of your life. There is, under tax reform, a penalty of 10% on all amounts withdrawn from the annuity before age 59 and a half. The penalty is overcome, however, in just 3 to 5 years from the tax-free compounding. So just think of the penalty as a withdrawal charge.
Strategy 4-54. Never annuitize your annuity account.
Always withdraw your money as required so no part of it becomes the property of the insurance company.
Strategy 4-55. Use the tax-free rollover rules to move your annuity to another company.
What if you become dissatisfied with one company's annuity program and wish to move to another? You may move your money to another company using the tax-free rollover rules. You would, however, be subject to any withdrawal penalty imposed by the company for early withdrawal. You may move your money from investment to investment within a self-directed annuity without becoming liable for any taxes, and in most instances without any charges or commissions.
Strategy 4-56. Make your annuity account withdrawals tax-free by creating equivalent tax deductions.
One annuity benefit was lost in the Economic Recovery Act, treating the first money you withdrew from your account as non-taxable principal instead of taxable interest. The rules now require that when you make a withdrawal, the first money withdrawn is treated as taxable profits instead of principal. Your strategy is clear. Any year you withdraw money from an annuity, create an equal amount of tax deductions using any tax strategies you choose. One will offset the other, and in essence, your withdrawal will be tax-free. If you have been investing your money in a low-interest, highly taxed bank certificate of deposit, or if you're considering single premium life insurance, a self-directed annuity is a far better alternative. Let's talk about how you invest in a self-directed annuity. Investing in an annuity is as simple as opening a bank account. Call several self-directed annuities using the telephone numbers listed in the chart in your reference manual, and ask the annuity for a prospectus. Check the prospectus to determine your different options for investments. Be certain you have all the options necessary for using the money movement strategy, which means stock funds, bond funds, and a money market fund, or fixed rate investment. Determine what procedure is required to move your money from one fund to another, whether you can do it by phone or a letter is required. And find out how often you're allowed to change investments. Complete the application for the annuity you choose and mail it along with your check. Use the list of questions to help evaluate the annuity.
Strategy 4-57. Invest in an annuity only with funds you plan to leave invested for 5 years or longer.
Annuities are commission-free if you leave your money invested long enough. To discourage you from moving your money in and out, most annuities have a decreasing load or commission. If you withdraw your money the first year, the maximum commission of, let's say, 5% would be deducted. The commissions decrease by 1% each year until after the 5th year, when the withdrawal charge reaches 0. Make certain there is no commission charged when you invest. No front-end load, in other words. You may move your money from investment to investment within a self-directed annuity, usually with no commissions, although a couple charge $5 for the move.
Strategy 4-58. Use your self-directed annuity as an estate planning tool.
The major goal in planning your estate is to pass on your wealth without letting the government and attorneys get their hands on it. Currently, you can distribute, undisturbed by the tax collector, any amount of an estate to a surviving spouse or up to $600,000 in assets to other beneficiaries. Annuities are great estate planning tools because they avoid probate. Annuities, like insurance contracts, allow you to nominate a beneficiary, one who would receive your annuity investment without probate if something happened to you.
Section 5. Tax preparation and tax planning.
The biggest lifetime expense you'll ever encounter is neither a home nor a college education, but income taxes. What we were never taught is that the amount of income tax you are liable for has little to do with your total income and everything to do with your knowledge of tax strategies. Where do we begin? By learning to turn the money you spend into legitimate tax deductions. Do you know that up to 60% of your income each year can be tax sheltered by combining personal expenses with tax deduction strategies? The tax system is not your enemy unless you don't understand it. Your objective is to work with the tax system from an ethical business perspective. In business, the objective is to increase profits by reducing expenses. In your personal life, your objective is to increase your spendable income by reducing your taxes.
Strategy 5-1. Use only tax strategies, never loopholes or tax cheating.
In pursuing the dream of lower taxes, it is never necessary to resort to tax cheating, loopholes, or even to question the legality of the tax system. There is a big difference. Tax cheating is understating your income or claiming tax deductions for assets you don't own or expenditures that you never made. Loopholes are gray, untested areas of the tax law that allow you to claim what I call default deductions, things that Congress and the IRS might have ruled against had they had the foresight to see the possibilities. Since a specific no does not exist, you create a loophole by saying yes to a shaky deduction. Loopholes are often sought after by desperate high-income taxpayers who never took the time to plan. Tax strategies are positive legal uses of the tax laws to reduce your income taxes. Tax strategies are actions you take that automatically and legally qualify you for additional deductions. These action strategies can include opening an IRA account, starting a small business, buying real estate, and dozens of other possibilities. Some tax strategies, like those just mentioned, are straightforward and obvious. Other strategies, like traveling on tax-deductible dollars and a tax-deductible college education for your children, are just as legal, just as easy to use, but less understood. One question I'm asked over and over again is paying less taxes really legal, patriotic, and moral? For some reason, many people seem to confuse our tax system with the United Fund, whose slogan is, pay your fair share. By following the tax laws and regulations, when you use tax strategies, you automatically pay your fair share, even if your share amounts to zero. Let's look at an example. Two neighboring families, each with a $30,000 annual income and 2 children, could both be paying their fair share of income taxes, even if one family paid $5,000 and the other family paid nothing at all. It's the way the American tax system was designed. We have a system in America that imposes taxes not on your total income, but on a far smaller number known as your taxable income. Now, your taxable income is your residual income after you subtract your exemptions, adjustments, and deductions. Within the difference between total income and taxable income lie your opportunities for applying legal, powerful tax-reducing strategies. The question of the legality and morality of tax deductions was settled once and for all over 40 years ago by the United States Circuit Court of Appeals in an opinion written by Judge Learned Hand. He said, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose a pattern that will best pay the Treasury. No one owes any public duty to pay more than the law demands. This decision should govern both your tax plan and your tax attitude. Rearranging your affairs to create deductions where you had none before is the secret to paying less in taxes. All of the tax strategies you will learn will legally and easily reduce your taxes by thousands each year. Your job is to pick those strategies that best suit you and your family. Tax strategies should form 1/3 of your written financial plan. How much time is required? Reducing your taxes is basically a do-it-at-home, do-it-yourself, do-it-in-your-spare-time project requiring no more than a few minutes a week. You'll soon discover that 1 hour spent learning and applying legal tax strategies will save you $100 to $300 in taxes. That's like having a $100 to $300 per hour tax-free job.
Strategy 5-2, determine your tax bracket to track your tax savings.
Our nation has a graduated tax system. That means the more you make, the more they take. Many taxpayers incorrectly believe that by earning more money, they can end up with less money because they move into a higher tax bracket. Not so. The higher bracket percentage applies only to the additional income you earn and does not affect the amount of taxes you pay on the amount of money you were already earning. Never fall back on the excuse that you don't want to make more money because you'll end up in a higher tax bracket. Instead, make all the money you can and reduce the taxes you pay by using tax strategies. The first step is to know your tax bracket. It's like assessing the damage, knowing the percentage of each dollar you earn that is lost forever. For example, if you're in the 28% tax bracket, you work from 9 a.m. to 11:30 each day for the government, and the rest of the 8-hour day you get to work for yourself. Your effective tax bracket is the percentage of your total income you pay in taxes. If your total income is $40,000 per year and you pay a total of $5,000 in federal, state, and local taxes, your effective tax bracket is 12.5%. That's $5,000 divided by $40,000. In tax planning, knowing your effective tax bracket will motivate you to create a good tax plan. Your marginal tax bracket is even more important than the effective tax bracket. Your marginal tax bracket is the percent in taxes you pay on your top dollar of taxable income. It also represents the percent of tax you will pay on your next additional dollar of income. Most importantly, the marginal tax bracket is the percentage of tax you will save for each additional dollar of tax deductions you create. Let's refer to the tax rate schedules under tax reform. This will show you your marginal bracket and the amount of tax you will pay based on your taxable income in 1988 and beyond. Your marginal tax bracket is the percentage shown in the right-hand column of each schedule. There are 3 different types of personal income taxes: federal, state, and local. Everyone is subject to federal taxes, but 11 states have no state income tax. Most people are not subject to local income taxes except in large metropolitan areas such as New York City and Washington, D.C. Most federal income tax deductions are allowed on most state tax returns. The average percentage for those who pay state taxes is 7%, and that's applied to your taxable income. Add 7% to your federal marginal tax bracket if you are subject to state income taxes, and you can see why you have so little money left. Let's be sure you know how to compute your marginal tax bracket. Refer to the tax rate schedules under tax reform chart. Let's say you're married filing jointly. Your income is $42,000 a year. That's your taxable income. Notice that $42,000 falls between $29,750 and $71,900. Using the lower marginal bracket, you're paying taxes at 28%. On each dollar of your income over $29,750, you're paying 28 cents out of every dollar. However, for every $1,000 in tax deductions you create, you will save 28%, or $280 per thousand.
Strategy 5-3. Cut your adjusted gross income to increase allowable itemized deductions.
Under the new tax laws, the amount of medical and miscellaneous deductions you can claim are partially dependent on your adjusted gross income, which we'll call your AGI. Since medical expenses are deductible only in excess of 7.5% of AGI, and miscellaneous expenses such as job-related expenses are deductible only in excess of 2% of AGI, your goal is to reduce your AGI. Refer to the form called Computing Your Adjusted Gross and Taxable Income to help increase certain itemized deductions. Notice that a small business loss, IRA contributions, and real estate deductions all reduce your adjusted gross income. As you use the tax strategies in this book, keep track of your deductions as you create them. You will notice that as your taxable income gets smaller, your taxes become less and your spendable income increases. The purpose of a good tax plan is having more money to spend. Referring to the chart labeled Computing Your Adjusted Gross and Taxable Income, this is a good point at which to get out your last year's tax forms and see how you stand with your adjusted gross income and your marginal tax bracket. By completing part 1, 2, and 3 of this calculation sheet, you will determine your adjusted gross income, taxable income, and marginal tax bracket. These are the numbers that you must know in order to plan your tax life effectively. The 4-letter word that keeps most people from becoming better tax strategists is fear. Most fear in life comes from lack of knowledge, seldom from any real threat. In the case of the IRS, fear is usually founded in fantasy and not fact. Fear of an audit, fear of embarrassment, fear of harassment, and worse yet, of course, fear of jail. Unless you are an outright tax cheater, you have nothing to worry about. To succeed financially, you must have the confidence to use tax strategies. Confidence and courage come from knowledge of how the tax system really works and how to use the system in your favor, while keeping both the IRS and Congress on your side. The best way to handle an audit is to avoid one in the first place. There are 4 basic ways to avoid an audit. Number 1, a good tax plan. Number 2, good record keeping. Number 3, filing as late as possible. And number 4, knowledge of how the tax system works. Years ago, when I was designing computer systems for a major corporation, I was a member of an association of computer professionals that included current and former IRS computer systems designers and programmers. Often late at night, over a beer or two, they would tell me little-known secrets of the IRS computer system. The tax strategies in this chapter are based partially on information obtained at those late-night social gatherings and from my experience over the years in working with thousands of taxpayers and tax professionals.
Strategy 5-4, use the long form. You cannot pay more in taxes, only less.
You may be one of the few who think you don't need a tax plan because you fill out the short form and can't take deductions. That's the first tax mistake. Those who fill out the short form are paying the absolute maximum tax which can be paid on that level of income. Always complete the 1040 long form to identify potential tax deductions. If you don't have more than the standard deduction, the long form will point out where your tax plan is lacking. Completing the long form will also familiarize you with the process of turning deductions into dollars. Those who have never completed a long form are those who usually claim they understand little about taxes, and they are also those who are normally living paycheck to paycheck. Long forms are a necessary part of tax strategy training and are not at all difficult. Use Tax Publication 17 as your guide. Filing the long form can never cost you more, only the same or less. To get Tax Publication 17, your federal income tax, simply call IRS. The publication is free.
Strategy 5-5, choose an aggressive tax preparer or none at all.
Whether or not you use a tax preparer is strictly a matter of choice. Almost 60% of taxpayers use a tax preparer, and with the complexity of the new tax laws, more will probably look for help. A good tax preparer is an aggressive tax preparer, and like four-leaf clovers, they are hard to find. Many tax laws and rules are written to intimidate tax preparers into becoming unnecessarily meek, mild, and conservative, even though these same laws and rules don't apply to you as a taxpayer. If your tax preparer is full of warnings such as, "I wouldn't take that deduction, it might send up a red flag," and short on explanations, the money you're paying for so-called tax advice pales besides the money you are unnecessarily paying in taxes. The most effective way to choose a good tax preparer is to interview several with one key question: how much in taxes did you pay last year? If the answer is much more than zero or a hedge like none of your business, you're dealing with a tax loser, not an effective tax preparer. If a tax expert can't help himself pay less in taxes, how can you expect that he will be able to help you? Another approach is to quiz your friends until you find one who is near the zero tax bracket. Use his or her tax preparer. But even if you use a tax preparer, you must still learn to communicate effectively about taxes. Now, one good reason to go to the Delta Group meetings is that you, as a Delta Group member, have the opportunity to network with other members, finding good tax preparers in the process.
Strategy 5-6, increase or decrease your end-of-year withholding to avoid penalties or get your refund for Christmas.
Under the new tax laws, the amount of withholding from your paycheck required to avoid penalties was increased from 80% to 90% of your total taxes due. If you had too little withheld during the year, you can have any amount of extra money withheld from your end-of-year paychecks to make up the difference. Every November, pencil in a 1040 form with your approximate income and deductions. If you will be short of the required withholding amount, have your employer withhold extra taxes for your last few pay periods. If you have had more than 90% withheld, you can reduce your end-of-year withholding to as little as zero and use that extra money for Christmas.
Strategy 5-7, prepare your own return at least once.
One question I'm often asked at my workshops is, should I prepare my own return? The answer is yes, completely once and partially each year. Without understanding how adjustments, credits, and deductions affect your tax return, you will never feel confident about handling the tax system. You can save yourself both money and time at tax preparation time if you pencil in your income and deductions, even if you take your papers to a tax preparer for the final version. This process will discipline you into becoming a better record keeper, as well as operate as a checklist to be certain you have everything organized. Your tax preparation will become much easier and your bill for tax preparation much smaller. There are also hidden traps in the way that your tax preparer may take tax deductions. Tax preparers may, for instance, choose alternatives for automobile, interest, or investment deductions that save preparation time but give you far less in deductions. You must be in a position to tell your tax preparer what forms and formulas to use if you want to pay less in taxes.
Strategy 5-8, time your refund to earn extra interest.
The IRS must send you any refund due within 45 days from the date you file, or April 15th, whichever is later. If your refund is late even 1 day, you're entitled to interest from the filing date. To get your interest, you may have to notify the IRS by sending in a claim. Always calculate the number of days between filing and refund.
Strategy 5-11, when in doubt, deduct it.
Most taxpayers think they are doing themselves a favor by being ultra-conservative in taking deductions. Nothing could be further from the truth. If you are tax deduction shy, not only do you end up spending thousands of dollars in unnecessary taxes, you don't even reduce your chances for an audit. Most audits are done at random and have little to do with whether you take all of your allowable deductions or just a few. If you want to reach your financial goals, you must adopt the winning tax strategy. When in doubt, deduct it. Take everything the law allows. Follow the rules, but deduct all gray areas in your favor. Gray areas are not loopholes or an attempt to get around the tax laws, but areas of ambiguity and uncertainty about what Congress or the IRS really meant. You have just as much chance of winning your point as the IRS does. You'll be surprised as you learn more about taxes at how much of the code is ambiguous. Simple record keeping and tax strategies will always have you prepared to win your point. When you hear a tax preparer say, "Well, I wouldn't take that deduction even though it's legitimate, it might send up a red flag," fire him.
Strategy 5-12, sign your return yourself.
The IRS audits a greater percentage of returns signed by experts than by individual taxpayers. The reason? The IRS found that tax professionals make more mistakes than taxpayers. The statistics are as follows. 30% of returns prepared by taxpayers contain errors. 40% of returns prepared by CPAs and accountants contain errors, and over 60% of returns prepared by franchise tax preparers contain errors. If a tax preparer has prepared your return, he must by law sign it. But if you simply get tax advice or assistance in preparing your own return, you may sign it yourself. Signing your own return cuts your chances of being audited by about 20%, but does not prevent you from taking a professional with you if you are audited. There is an exception. If you earn over $50,000 per year in total income, your chances of being audited are less if a CPA or tax preparer signs your return. The IRS somehow believes that even though you're smart enough to earn that kind of money, you're not smart enough to prepare your own tax return.
Strategy 5-13, file your return later, not earlier.
The later you file, the less your chances for audit. If you file your tax return each year after April 1st, you have automatically reduced your chances for audit by about 40% over those who file in January, February, and March. The reduced chance for audit is due to a quirk in the IRS's computer program and how it selects returns for possible audit. The IRS will tell you it's not true, but it is. Here's how it works. The IRS has only 24,500 auditors to do 130 million returns and has suffered budget cuts like all governmental branches. The number of returns to be selected for each deduction category is programmed into the computer. Returns for possible audit are then selected on a first-come basis, and when the total number of returns for a category have been chosen, the computer stops selecting. The later you file, the more categories are full.
Strategy 5-14, File an automatic extension Form 4868.
You can reduce your chances for audit even further by filing IRS Form 4868, Automatic Extension of Time to File. The automatic extension gives you an extra 4 months until August 15th to file your tax return for the previous year. Interest is charged on unpaid taxes at less than 1% per month, but there is no late filing penalty. Another 2-month extension can be requested in writing and is almost always granted, moving your required filing date to October 15th. Isn't it strange how the possibility of an audit makes you feel guilty even when you're not? An audit is nothing more than your opportunity to prove to the IRS that you're a good record keeper. If you're not, your first audit can go a long way in motivating you to become one. Fear of being audited comes from a lack of knowledge, not from any real IRS threat. All of us will be audited once or twice in a lifetime, no matter how carefully our returns are filled out. Be prepared rather than scared.
Strategy 5-15, don't react to an audit as more than it really is.
According to the IRS, an audit is an impartial review of a tax return to determine its accuracy and completeness. An audit is not an accusation that you've done something wrong, only a request for more information. Knowledge of audit objectives and proceedings gives you the same level of power and clout that most taxpayers attribute to the IRS. Knowledge will reduce an audit to the impartial review that it's supposed to be. Of course, an audit is a hassle. Anything you do that doesn't contribute to your wealth, health, family, relaxation, or goals is a hassle. Grin and bear it. Look at an audit as part of the game, just as painful exercise is part of building a strong body. Most people try to avoid an audit by being conservative and maintaining a low profile. The thousands of extra dollars a person pays in federal income taxes over the course of a lifetime just to avoid 1 or 2 audits is simply not worth the price. More importantly, being over-conservative doesn't really help reduce your chances for audit. What are your real chances for being audited in any one year? Let's take a look. Out of 96 million individual tax returns, less than 2 million returns are audited, about 2%. Even so, it's important to know the rules of the game. Based on past performance of the IRS, here are your percentage chances for being audited by income and by profession. Individuals. If your total income is under $50,000, you have only a 2% chance each year of being audited. If your income, however, is over $50,000, your audit chances pop up to 8%. Now, if you're a professional, doctor, dentist, accountant, CPA, you have a whopping 25% chance each year of being audited, and you're second only to known criminals who have a 50% chance of being audited. Therefore, it's your profession more than anything else that determines your audit profile. Now, let's say you own a small business or start one. What are your chances for audit? If the income for your small business is under $10,000, your chance for audit is 3%. $10,000 to $30,000, 2%, and over $30,000, 7%. Now, that's not in addition to your chance for being audited as an individual. That's combined. If placed on a shelf, the tax code regulations and manuals would stretch 40 feet and fill close to 50,000 pages. It's no wonder the tax system is such a mess. Even the IRS is confused. The General Accounting Office of the United States has said that the IRS phone representatives give the wrong answer to at least 1 out of every 10 questions. USA Today hired CPAs to call the IRS with a list of 10 questions. The IRS actually gave the wrong answer 40% of the time. I realize that these facts aren't particularly comforting, but at least you can begin to see that IRS professionals are human and make mistakes. Understanding this situation will help you walk into any audit feeling a bit more confident and comfortable. Let's look at how your tax return can be chosen for an audit. The TCMP audit. The TCMP audit, which stands for Taxpayer Compliance Measurement Program, is based on random selection. Doesn't matter how much or how little you make or what deductions you take, everyone who files a tax return has an equal chance for a TCMP audit. Each year, only about 40,000 out of the 96 million returns are selected for the TCMP audit. The purpose, according to the IRS, is to find out exactly where taxpayers make mistakes and even where they tend to cheat. The audit is so thorough that if you have children, you may be asked to bring birth certificates to prove that they're your dependents. Don't be too concerned. About 1/3 of TCMP audited taxpayers walk out the door with a bigger refund check in hand. The second technique used by the IRS for selecting audit candidates is called target group selection. IRS experience shows that certain professions have high cash incomes, which shouldn't come as any big surprise. Any profession from which the IRS feels it can collect the greatest amount of extra taxes for the number of man-hours spent has a higher audit profile. These groups include doctors, dentists, lawyers, airline pilots, and accountants. All of the people you'd like your son or daughter to marry. Discriminant Function System, or DFS. Last but certainly not least is the Discriminant Function System. DFS is a point system. The deductions on your return are compared to what the IRS considers the norm for a person in your profession, in your area, and with your income. The greater the difference between your tax return and the norm, the higher number of points you're assigned. If your DFS score gets too high, you may be chosen for an audit. If you're selected by computer for audit, 2 IRS employees must agree that there is a good chance of collecting additional taxes before you are actually issued an audit notice.
Strategy 5-16, delay an audit as long as possible.
Keep in mind that the world of IRS is not a clandestine behind-the-scenes ring of spies bugging your phone and watching you through infrared binoculars. The IRS is simply a big collection business run by the government, and your success with the system is assured when you take an honest, business-like approach. If you're picked for an audit, the audit notice will usually be in the form of a computer-generated letter. Federal law states that the time and place for an audit must be convenient to both parties. That's you and the IRS. Your strategy is to delay the audit as long as possible. You may send a registered letter to the IRS in answer to the audit notice stating, "The time is not convenient." Your response automatically postpones the audit. Eventually, after several postponements, you'll receive a letter or call from a real live person instead of the computer. And that call will ask you to choose the time. By then, you'll have your records in order.
Strategy 5-17, never go to an audit until you get the reasons in writing.
Before you agree to an audit time, get all of the following information in writing. The IRS must give you the written answers to the following questions if you ask before you're required to appear. Question: why? Why is the IRS auditing your return? Why does the IRS think it may be able to collect more taxes? Is there an error that can be rectified easily without an office visit? Can you furnish copies of supporting documents by mail? Question: which? Which parts of your return are being audited? Ask for a specific answer. The answer the IRS gives to this question limits the audit to these parts of your return. Some of the information you require may come with the audit notice, and some you may have to request yourself in writing. Question: what? What papers does the IRS want to see? Take to the audit only the papers requested, not your shoeboxes full of old receipts, contracts, and checks. If the IRS says, bring everything, request they be more specific by listing what everything includes. There are some important ground rules you will want to follow during an audit.
Strategy 5-18, if a tax preparer prepared your return, take him or her to the audit.
If a tax preparer prepared the return, you should certainly take him or her to the audit. If you feel you are knowledgeable and confident about taxes and your tax return, you can handle it yourself. But you will want to take a professional if the taxes in question are significant or if you tend to react emotionally. IRS auditors are not intimidated by tax professionals, but they do speak the same language. If you paid for the service, use it.
Strategy 5-19. Let the auditor look at your documents only once.
The auditor has the right to look at each of your documents only one time. Under a recent ruling, if your auditor wants to look at your papers a second time, written permission must be obtained from the U.S. Secretary of the Treasury. It can be done, but the auditor usually won't go to all the trouble if you mention this rule.
Strategy 5-20. In an audit, never part company with your original documents.
Don't leave original copies of your papers with the IRS. A tax court has ruled that you're still responsible for your records even if they're lost or misplaced by the IRS. Point out to the auditor that if there is a need for extra work on your papers, you will bring them back later.
Strategy 5-21. Don't let the auditor copy your tax file.
The tax law does not give the IRS blanket permission to build a file from copies of your personal papers. You must produce supporting documents if requested, but not copies for the IRS's file.
Strategy 5-22. Learn how to behave in an audit.
It's important to mind your manners when you're being audited, but contrary to what many people believe, you can be aggressive and well-mannered at the same time. Here are the rules to follow. First, say little, smile a lot. Never volunteer information. If you feel strongly about your position, let the auditor know. Often, the auditor will let the point go in your favor. Provide as much documentation as possible for each point in an audit. Don't give up, even if you don't have all the documentation. Don't make too many concessions. Don't be rushed unless you feel hurrying will work in your favor. Don't complain about the tax system. Remember, the auditor pays taxes too. Don't take crumpled up receipts in a brown paper bag. That old strategy won't work anymore. Auditors are trained to believe that if you keep your records in a disorganized manner, there must be an error in there somewhere. Don't take the Fifth Amendment. Tax protesting is a disaster. The jails and courts are full of people who believe such nonsense would work. Don't try to tape record the conversation. The IRS found from experience that recording tended to fluster the auditors. Recording once was a great way to get control of an audit, but now you will have to go to court to get permission to record. Even if you win, it's not worth the trouble. Act with confidence that you're right. You probably are.
Strategy 5-23. If you don't get what you think you deserve, go beyond the auditor.
If all else fails and you can't get the decision you want, you still have a few cards to play. Step 1. Ask for the supervisor. Auditors are taught to rule gray areas in the IRS's favor. Supervisors are taught to rule gray areas in favor of the taxpayer. Supervisors also have a greater knowledge of the tax law and its application than do auditors. Supervisors are the first level of the public relations effort at the IRS, so they try to please. I cannot tell you how many stories I hear in my workshops of those who have paid extra taxes for denied deductions even though the auditor was 100% wrong, because the individual being audited didn't know what to do next. Step 2, call the Problem Resolution Office. The Problem Resolution Office, or PRO, was set up to help keep the IRS out of court. The Problem Resolution Office has the power to compromise and resolve taxpayer disputes. You'll find the phone number for the PRO in the phone book under U.S. Government Internal Revenue Service Problem Resolution Office. Step 3, take them to court. You may use the small claims court to settle any dispute with the IRS once and for all. The taxes in question must be under $10,000 to file your case. You're not even required to take an attorney, and the regular courtroom rules of evidence are relaxed. You present your side of the argument, the IRS presents its side. The impartial judge listens, leaves the courtroom, eats a sandwich, returns, and tells you his decision. Now, the decision is final. There are no appeals in small claims court. Step 4, use the appeals and review system. If the taxes in question are over $10,000, you must use the regular appeals and review system to appeal the auditor's decision. The cost involved will obviously be more, but good planning and understanding the do's and don'ts of taxes will avoid any problem. IRS publications completely outline the appeals and review procedure.
Strategy 5-24, apply the statute of limitations to an audit.
Once you file, the IRS has a limited time to challenge your return. The statute of limitations is effective 3 years from the day your return was due, April 15th, or the date the return was filed if it's later. If you understate your total income by 25% or more, the statute of limitations is 6 years. If your return is fraudulent, there is no statutory limit to the IRS audit period. If the statutory period has expired, you cannot be audited no matter how badly the IRS may want to audit you. But the pendulum swings both ways. You also have a limit of 3 years to amend your return and claim any overpaid taxes or forgotten deductions.
Strategy 5-25, agree only to a limited extension of an audit.
If you're being audited and are close to the statutory limit, you will be asked to sign an extension. Instead of signing the form the IRS will give you, which leaves your entire return open to examination past the statutory period, request and sign Form 872, Limited Extension. This procedure leaves open to examination only the parts of your return in question, those you specified on the Limited Extension form. It's also acceptable to the IRS.
Strategy 5-26, put a stop to the hassle audit if you've been audited during the past 3 years.
If you're audited on any part of your return in 1 year and the audit produces no change or only a small change, you should not be audited on the same part of your return for the next 3 years. The IRS often will not apply this rule unless you bring it up. Several years ago, during one of my money strategies workshops, a young man stood up abruptly, stating that he'd been audited for the same deductions 3 years in a row. He was to appear for an audit again on the following Monday. He decided to test the hassle audit rule based on what he had learned in my workshop. When he pointed out to the auditor that he had been audited 3 years in a row for the same thing, the auditor checked the files and said, "You're right, we didn't realize we'd audited you last year." The audit was over as quickly as it began. To sum it up, your best defense in an audit is a good offense. Be civil, knowledgeable, and assertive. Remember, knowledge eliminates both fear and bigger tax bills. The more you learn about how to report your income and deductions correctly, the less your chances for an audit.
Strategy 5-27, sell your home to your children.
If parents or even grandparents sell their home to their children, both parents and children generate tremendous financial and tax benefits. The parents are able to unlock the equity in their home tax-free without having to move, while the children receive depreciation and other tax deductions and the future appreciation of the property. The home, because it is then owned by the children, is a protected part of the parent's estate. If Congress has its way, however, in the next couple of years, the maximum amount that will be allowed to pass through an estate tax-free will be reduced from the current $600,000 to as low as $200,000. Getting your home, one of your most expensive assets, out of your estate is an important step in your estate plan. Now here's how the strategy works. First, parents sell their home to their children at fair market value determined by appraisal. 2, the children purchase the property with a conventional 80% mortgage. Now the parents can hold a second mortgage note for all or part of the balance and even co-sign on the first mortgage if necessary to help the kids qualify. An alternative strategy would be for the parents to get a new mortgage or equity loan themselves before selling to the children. Then they could let the children assume the mortgage. The cost of assumption is usually about 1%, unless the loan is assumed as a no qualifying FHA or VA loan. Now, the only cost in assuming those loans is $45. Let's look at an example. If the home is paid for and worth $150,000, parents would receive $120,000 cash from an 80% mortgage. 3. Parents can elect, using Tax Form 2119, to take the once per lifetime $125,000 tax exemption to tax protect the accumulated profits from the sale of the home. 4. Parents rent the home from the children and must pay at least 80% of fair market value rent in order for the children to qualify for tax deductions. That's an IRS rule. If the fair market value rent is $600, parents must pay at least $480 per month, or about $6,000 per year. The rent money is a portion of what parents are earning from reinvesting their home equity. The children now own an appreciating property, throwing off generous tax deductions, and they also have built-in property managers, their parents. Parents will want to lease the property back from the children with a lifetime lease. So if parents and the children have a little spat, the parents won't end up in the street. Don't laugh. It's really happened. Number 5. Using a combination of investments, such as mutual funds and discounted mortgages, which will average an after-tax net of 15%, parents' income from reinvested home equity would total $18,000 per year. After paying the $6,000 in rent, parents have increased their tax-free income $12,000 for the year, or $1,000 a month. Now that's the right way to use home equity. Number 6, parents may wish to increase their rental payments to the children to equal the payments the kids are paying on the mortgage. The tax deductions the children receive will also help offset the mortgage payments. Here's how. Let's say the basis for depreciation of the property is $120,000. That's the $150,000 purchase price the kids paid, minus 20% for the land value. The yearly depreciation deduction, based on a 27.5-year depreciation schedule, would be $4,364. The kids would save, if they're in the 33% bracket, $1,440 per year. And that money, of course, helps offset the mortgage payments.
Strategy 5-28. Buy a home with your children or grandchildren.
Buying a home with and for your children or grandchildren can be a financially and personally rewarding experience. If you are the children, talk to your parents or grandparents about this. The children or grandchildren agree to live in and maintain the property as well as make all of the mortgage payments. And both parents and children get the tax and appreciation benefits of a sound real estate investment, all with no management headaches. If you're the co-owner who lives in the property, you enjoy these financial and tax benefits. First, you qualify for a mortgage you might not be able to get on your own. Second, your down payment is reduced or eliminated altogether. Third, you can stop renting and start building equity for the future. Fourth, when you sell, you may use the tax deferral rules for rolling over your share of the profits to another home, all without paying a dime in income taxes. You're also allowed a tax deduction for your share of the mortgage interest and property taxes. Now, if you're the parent or grandparent who co-owns, but you don't live in the property, you enjoy these financial and tax benefits. You can help someone you care about own a home. You have a resident property manager. There are no vacancy problems. You are allowed a tax deduction for your share of the depreciation, interest, property tax, and maintenance expenses. The resident owner is not allowed to take depreciation, but the non-resident owner can. This strategy can also be used by parties who are not related. Profits on the eventual sale of the property are divided based on the percentage ownership of each party. Let's talk about some estate protection strategies, a necessary part of family planning. Income taxes are expenses that you work to reduce in order to build your estate, and estate taxes are expenses you work to reduce in order to protect your estate for your surviving family members. The minimum estate tax begins at 55%. That's why good planning is so important. Now, the minimum was supposed to drop to 50% in 1988, but the reductions have already been canceled. The estate tax applies only to money or property given to someone other than your spouse. Here's an important rule. You may leave to your spouse unlimited amounts of property or cash without estate taxes. What can you do to protect more of your estate? Here are your strategies.
Strategy 5-29. Keep your will up to date.
Your estate taxes may be increased unnecessarily by the outdated language in your will, simply because Congress changes the tax laws. Have both your attorney and your accountant check your will every 3 years to see that it conforms to ever-changing rules.
Strategy 5-30. Give gifts to children in order to reduce estate taxes.
During your lifetime, you can give to each child up to $20,000 per year, only $10,000 if you're single, and this gift has no gift taxes associated with it. This money or property is then out of your taxable estate. Under the pre-1981 rules, any gift made within 3 years before death was added back into the estate for tax purposes. This rule has now been repealed. While you're living, you can maintain control of the assets you give your child or grandchild by putting them into an inter vivos or lifetime trust. Control means you can choose where the trust money is invested and whether you or someone else receives the income from the trust.
Strategy 5-31. Create an irrevocable trust to protect your estate.
An irrevocable trust allows you to funnel money out of your taxable estate into an investment trust for the future benefit of your heirs, usually your children or grandchildren. You may put into the trust each year up to the gift tax limits that we talked about a little earlier. There is no gift tax now and no estate tax later. Your heirs do not get the money in the trust until your demise or some other stipulated event chosen by you. There are 4 important considerations before you consider an irrevocable trust. 1, you cannot receive the income from the trust investments. The money must either accumulate in the trust or be given to the beneficiaries. 2, irrevocable means you cannot change your mind and get the assets back. 3, the irrevocable trust usually costs $3,000 or more in attorney's fees to establish, so it should be used only where proven benefits can be obtained. 4, you don't need the trust if your sole beneficiary is your spouse or your net estate is less than $600,000. Before even considering such a trust or contacting an attorney, read Norman Dacey's book, How to Avoid Probate. Choose an attorney who specializes in trusts if you decide to form one.
Strategy 5-32. Use a dual trust to double the tax-free status of your estate.
By using a dual trust, you can protect more of your estate, actually double. Your estate can be set up in a trust to give your children or grandchildren up to the maximum that can be passed tax-free to the next generation. Now that's currently $600,000. The balance can be given to the surviving spouse under the unlimited marital deduction rules. Your spouse may also then pass the maximum of $600,000 to the next generation without estate taxes. Instead of the couple being able to pass only $600,000 to the next generation tax-free, they have increased the tax-free pass-through to $1,200,000. The surviving spouse can get the income from the trust with the principal eventually passing to the children.
Strategy 5-33. Give charitable gifts in order to lower your estate taxes.
Consider making charitable gifts while you are living if you have a project or organization you believe in. Why? You can take the tax deduction for the gift while living and keep the gift amount out of your estate when you compute your potential estate taxes. You have effectively doubled your deductions. Remember, there's more to your tax life than income taxes. Gift tax and estate tax avoidance strategies must always be a part of your overall financial plan. Now let's talk about investment plan deductions, an important part of family tax planning.
Strategy 5-34. Turn your investment plan into a tax shelter by deducting investment expenses.
A family investment plan should generate more than current income or a brighter financial future. It should create hundreds in extra tax deductions for investment expenses. Most taxpayers mistakenly think that expenses associated with their investment plan are no longer deductible. Even the simplest investments can generate $500 to $1,000 of tax deductions. The IRS rules are very clear on the subject. Here's what IRS says. Expenses incurred in the production and collection of investment income are deductible as part of Schedule A miscellaneous deductions. Use the deductible investment expenses checklist as a guide to investment expense deductions and investment expense planning. You'll find that checklist in your manual. All other investment expenses you incur may be added to the list. Let's take a look at some of your investment expenses which are deductible. Using the deductible expense form in the book, check those expenses on the left that you have, enter the amounts on the right. You may deduct accounting fees, automobile expenses, books and audio and video tape courses on investing, brokerage fees, calculator, adding machine, cassette recorder, typewriter you use in your investments, the cost of collecting interest and dividends, costs of managing investments for a minor like your child, financial advice on audio and video tapes like the Charles J. Givens Financial Library, home computer used for investment planning and record keeping, investment advice, except for advice on tax-exempt investments, your IRA setup costs, if they're billed separately, legal costs, meals and entertainment of investment advisors, proxy fight expenses, safety deposit rental, salary of a bookkeeper or others who keep your investment records, subscription to investment publications, trips to look after investments such as improved real estate, and even a video tape recorder used for investment education and advice. There are a few things that are not deductible. Costs of travel to stockholder meetings, cost of trips to investigate prospective rental properties, cost of travel to investment seminars, and home office expenses associated with your investments. You should be, as we said, able to generate $500 to $1,000 in deductible investment expenses.
Strategy 5-36, take advantage of the miscellaneous Schedule A deduction rules by combining over 50 potential deductions.
Now, one concern many taxpayers have is no longer can you get a 100% deduction for all of your miscellaneous expenses. There is now a 2% floor on miscellaneous deductions, which is based on your adjusted gross income. Most taxpayers with a little planning will be able to have between $1,000 and $2,000 of allowable deductions even after the floor is calculated because of the wide range of potential deductions included in this category. Here's a partial list of what you can include in this category to use as your guide. Included in the miscellaneous expense deduction category are any unreimbursed employee travel expenses, such as airlines, autos, meals, entertainment. Your tax advice and tax preparation also goes in that category. Investment expenses that we discussed earlier all fit in the miscellaneous deduction category, and other employee business expenses such as your automobile, education, legal fees, association dues, club memberships, your job hunting and interview expenses, employment agency fees are also miscellaneous deductions. If you put an office in the home for the benefit of your employer, the depreciation or rent is deductible, utilities are deductible, and family salaries for job assistance is deductible. Even moving expenses when you change jobs may be deductible as a miscellaneous expense. A floor of 2% of your adjusted gross income applies to your miscellaneous deductions. All of your expenses above the floor are deductible. Now, refer in your manual to the allowable miscellaneous deductions computation chart. Enter your adjusted gross income from last year's tax return. Find your adjusted gross income in the column on the left, and then reading to the right, you'll find your miscellaneous expenses which are deductible in excess of the floor amount shown. Enter the approximate floor amount at the bottom of the chart, subtract from your total miscellaneous deductions for the year, and you will see how much your allowable deduction will amount to.
Strategy 5-37, use job interviews to make vacations deductible.
If you work for someone else or have your own small business, the easiest way to make your vacations deductible is with job interviews. The tax code says that if, while you're traveling, you go on a job interview for the same type of job you now have, you're entitled to take a tax deduction for up to the entire amount you spend traveling. Who entitles you? Congress. Just never got around to telling us. Keeping tax records is easy. Have the personnel department where you apply make a copy of your job application. When you get home, drop it in your tax file with your airline, hotel, food, and rental car receipts, and your trip is deductible. Whether your job is as an executive, truck driver, nurse, or secretary, the only requirement is that the job you apply for must be the same or similar to the one you now have. If you're between jobs, you may qualify for the deduction by applying for the same type of job as the last one you had. You may qualify to make all of your travel expenses deductible by following a few simple IRS rules. To deduct 100% of your expenses, you must spend a minimum of 2 hours per day or 4 hours every other day, not including weekends, working on your deductible purpose. Keep the records of the time spent in your daily planner. You may set up multiple interviews, contact a personnel agency, or go to the library to research the company and the area. All of these count towards your time requirement. There's only one outside risk when using the job interview strategy. You might get the job. But after all, that's career advancement, certainly one of your more important goals. You've created a win-win strategy. You either get the tax deduction or a better job, big promotion, and maybe even palm trees in the wintertime. Your objective is to set up your entire financial life with these kinds of win-win strategies. No matter what the outcome, you profit. Now, your spouse may also use the job interview strategy to make his or her expenses deductible. What if you're offered the job and turn it down? Can you still take the tax deduction? Well, that depends. If you are not offered your salary requirements or job terms, you have every right to turn down the position and claim the deduction. If you're offered your terms, it would not be right to take the deduction, since the IRS could correctly claim that your job hunting was not a serious endeavor. Not trying to kid the IRS, doesn't fool easily, but we're only trying to take deductions for which we actually qualify. Write ahead to line up interviews. Your public library has telephone books for most major cities. Use the form letter included in your manual to set up interviews and establish the job search purpose of your trip. There are unlimited ways to apply the job interview strategy. Lisa, who worked for the governor of the state of Virginia and sang in nightclubs around Richmond as a part-time job, had always dreamed of singing on a cruise ship as part of the band. Lisa called Carnival Cruise Lines and was finally able to talk to a cruise director while he was in port. The cruise director told her she was welcome to try out with the band, but they were always at sea. That was just what she hoped to hear. She booked passage on a cruise to Bermuda, during which the band leader let her entertain the passengers for a few nights as an audition. Lisa loved it. The band leader thought she was great, but there just wasn't enough money available to hire another person. Lisa asked the band leader to put it in writing so she could place the refusal in her tax file. That year, Lisa took a tax deduction for her cruise to Bermuda. As a job interview, the IRS allowed the deduction. Reason is clear. She did go on a legitimate job interview, which she adequately documented. How fortunate that the job interview was on the cruise, and the minimum time she could spend on the cruise was 1 week.
Strategy 5-38, start a small importing company.
You can even make your international travel deductible by starting a small importing company. Your total investment? 2 empty suitcases. Take them with you to Mexico, South America, the Far East, and even Europe. While you're at your destination, your tax strategy is you go shopping. While visiting the marketplaces and bazaars, you buy the beautiful handicrafts and handmade items that are so inexpensive overseas and so incredibly expensive when you see the same things in the gift shops and department stores back home. Those are your imports, and that's what goes in the suitcases. Pick the things you know your friends would love to own. When you get home, have a party and invite all of your friends right down to your distant acquaintances. They're your customers. After you serve them the tax-deductible refreshments, bring out all the beautiful imports with a little price tag on them. You'll find, like so many I've taught this strategy to, that you'll sell out the first night and make more than enough profit to pay for your next trip. At tax time, you may take a deduction on Schedule C for all of your international travel expenses. The government will help you. Do you know there's no customs duty on artwork or handicrafts no matter how much you bring into the country? If some of the items are too big to carry and you decide to ship, have the merchant mark the package gifts and it will escape the customs cash register. In any case, you can bring back $400 per person of dutiable items free and pay only 10% of the cost on the next 1,000.
Strategy 5-39, become an outside agent for a travel agency.
You can have the benefits of a travel agent or agency without changing careers or even starting your own agency. By acting as an outside agent for any travel agency, you qualify to receive part of the travel agency's commission, up to 50%. The travel agency normally receives 10% of the cost of airline tickets and 15% commission on the ground arrangements such as hotels and tours. Choose a destination you'd like to visit and one that your friends and associates might also enjoy. Print simple brochures or flyers that explain your adventure and distribute them to fellow employees, club members, or even neighbors. The travel agency can furnish you with shells. Those are partially printed brochures with color pictures and blank areas for insertion of the time, date, and specific information about your trip. As an outside agent, you will have the chance to travel free. You usually get one complimentary trip for every 15 people who pay the regular price. The commission income from your trip will show your intent to make a profit and allow you to take a tax deduction for any of your own money spent. After your first successful trip, whether you take 3 or 50 people, begin planning other trips. You now have the right to travel anywhere to familiarize yourself with possible locations and hotels for group trips. Your travel costs, of course, are tax deductible. If your part-time travel enterprise earns you about $6,000 in commissions in any one year, you qualify for free and discounted airline tickets as well as familiarization trips around the world with discounts of as much as 75%. Contact any travel agency and get started as an outside agent. Under the new tax laws, over 50 favorite tax deductions have been changed or eliminated completely. One of the most devastating to taxpayers is the non-deductibility of consumer interest. Consumer interest includes interest paid on credit cards and installment personal college insurance policy and automobile loans. But the new consumer interest rules do not limit the interest deduction for mortgages, investments, and business loans. By converting consumer loans to legitimate mortgage, investment, and business loans, you can preserve your interest deductions. That's what this chapter is all about. The consumer interest deduction did not disappear completely with the onset of tax reform, but is being phased out over a 5-year period, which began in 1987. Here are the percentages of consumer interest that are still deductible. 1988, 40% deductible. 89, 20%, 90, 10%, and in 1991, no consumer interest will be deductible. Since $3 of tax deductions under the tax reform rules get you a cash refund of about $1, interest deductions dramatically cut the cost of borrowing money. Losing the interest deduction has the same effect as a tax increase. Let's take a look at how a typical family who owns their own home is affected by the loss of consumer interest deductions. This couple was deducting home mortgage, car loans, credit cards, personal loan, IRA, borrowed money, margin account, and college loan interest of $13,200 before tax reform. After tax reform, they get only a $9,200 deduction. The amount of deduction lost in this example is $4,000. And the family will pay $2,704 more in taxes just because of the loss of these deductions. By using the following strategies, you can significantly cut your taxes by making consumer interest deductible.
Strategy 5-40, use an equity loan or new mortgage to create deductible interest.
Mortgages are treated differently than consumer loans when computing deductible interest. Beginning in 1988, the interest is deductible on your first and second home mortgages up to $1 million of total acquisition cost. That's the price you originally paid for the homes. You may also deduct the interest on up to $100,000 obtained through an equity loan, no matter what the money is used for. For most Americans, all interest on refinancing will be deductible. Using the acquisition cost rule, you can get an equity loan on your first or second home to pay off your non-deductible debt and increase your tax refund in the process. Let's look at an example. Let's say you borrowed $10,000 to buy your first car, $6,000 to buy your second. You owe $4,000 on credit cards and $5,000 on a personal loan. Total amount borrowed, $25,000. If the average interest rate on these loans is 12%, 1 year's interest is $3,000. But the interest is no longer deductible under the consumer interest rules. Using a qualified home equity loan for $25,000 to pay off these loans, the interest becomes deductible. And if you're in the 33% tax bracket, you get $1,000 in additional cash back in your next refund check.
Strategy 5-41, qualify your boat or RV loan for deductible interest.
If you own or buy a boat or recreational vehicle which has sleeping and toilet facilities, you may treat the asset as your second home. All of the interest is then deductible up to the acquisition cost limits. As long as the cost of your primary residence plus your boat or RV does not exceed $1 million, the interest is fully deductible.
Strategy 5-42, use your vacation home as a second home instead of as a rental property.
To qualify your resort or vacation home as a rental property, you cannot use it yourself more than 14 days per year. And if you do, you may deduct the mortgage interest expense only up to the amount of rental income. If the property is rented only occasionally, you may get a greater deduction by treating the property as a second home and deducting 100% of the interest, plus the property taxes. If your income is too high to benefit from the $25,000 real estate expense deduction allowable under tax reform, deducting 100% of the mortgage interest on your vacation home is always your best tax alternative.
Strategy 5-44, pay off high non-deductible interest debt with low non-deductible interest debt.
If you have an insurance policy with an accumulated cash value, borrow on that policy at the 5 or 6% guaranteed interest rate and use the low interest borrowed money to pay off your high interest personal loans and credit cards. Even though the interest paid on the insurance loan will not be deductible, you may be saving as much as 12 to 14% per year interest by substituting low interest insurance dollars for high interest dollars. You can save more from an interest reduction sometimes than from an interest tax deduction.
Strategy 5-46, sell appreciated investments to qualify your investment interest expense as a deduction.
Interest on investment loans is fully deductible, but only up to the amount of your investment income for the same year. Investment income includes interest from CDs or savings accounts, dividends, and capital gains distributions shown on your mutual fund statement. Each December, check to be certain your investment income will top your investment interest expense. If not, consider selling some appreciated mutual fund shares, stocks, or bonds, since the profits count toward your investment income. The appreciated value of an investment you still hold does not count as investment income until you sell.
Strategy 5-47, convert consumer interest to business interest.
Interest paid on business loans or personal loans to finance assets used full or part-time in your business is deductible. Since the interest deduction is taken on Tax Schedule C or other similar business tax form, the deduction is not limited by the standard deduction amount on your Schedule A. For instance, even if you use your personal car financed with a personal loan in your small business and you allocate 60% of its use to business, 60% of the interest you pay each year is tax deductible. Let's look at an example. Jenny started a small business at home and used her car 60% of the time for business and 40% for personal purposes. Her car loan is $12,000 at 10% interest. Her total interest cost this year, therefore, will be about $1,200, of which 60% will be tax deductible. Interest you pay on a home computer or VCR loan is also deductible if the asset is used full or part-time in your business. And don't forget, the deduction applies even if you purchased the asset with a credit card instead of an installment loan.
Strategy 5-48. Use employee business deductions to turn your job into a tax shelter.
Here is a list of what you as an employee may deduct as job-related costs. I want you on the form to check those that do or could apply to you and enter the estimated amounts that you spend. Some of the things that are deductible as employee expenses include job-related airfares, association dues, automobile expenses, books and magazines, car insurance, Christmas gifts, cleaning, club dues, convention trips, correspondence courses, depreciation on assets that you use for your employer, displays or samples, education related to your job, furniture in a home office. Even the home office is deductible if used for your employer. House hunting if you have to move, laundry while you're traveling, legal expenses, liability premiums, meals, medical exams, moving expenses, musical instruments if you play in a band, parking fees, passport fees if you have to travel overseas, reimbursed expenses from your employer, repairs, safety equipment, salary of assistants who help you with your job, supplies, tape recorder you use for your employer, taxi fares, telephones, tips, tolls, tools you use at your job, a typewriter or calculator you may use, uniforms, and even union dues. That's just a partial list. Actually, anything that is job-related that you spend money on becomes deductible. You'll find a lot of opportunity for big tax deductions. In the strategies that follow, I'll teach you how to take some of these deductions.
Strategy 5-49. Deduct your employee business mileage.
When you use your automobile at your employer's request to run errands, drop off the mail, or pick somebody up at the airport, and your employer does not reimburse you, you may deduct 22.5 cents per mile for the first 15,000 miles and 11 cents per mile for the balance. If you are reimbursed less than 22.5 cents per mile, the difference is deductible. Now, if you work a second job, the mileage between your full-time job and your second job is deductible. There are two uses of your car that are not deductible under any circumstances: personal use and commuting. Personal use includes mileage for vacation, shopping, taking the kids to school, or visiting friends. Commuting is driving between your home and your job. Commuting is not deductible even if you drive to a different company office each day. There are exceptions for salespeople, inspectors, real estate agents, and construction workers. Use these rules. Your mileage from home to the first location and from the last location to home is not deductible. However, mileage between all your other locations is deductible at 22.5 cents per mile. You claim the actual expenses or the mileage rate on tax form 2106. There's a 2106 we'll use as an example later. You may also claim the employee business portion of your car loan interest on the same form. The personal use portion of interest is claimed as an itemized deduction on Schedule A. Now, the business portion of the sales tax is added to the cost of the car and depreciated if you use the actual expense method. The sales tax on the personal usage portion of your car is not deductible.
Strategy 5-50. Deduct your job-related education.
You may take tax deductions for any education, books, tapes, seminars, or adult classes that help you perform your present job more effectively. The deductions include tuition, lab fees, mileage, and even other travel expenses. No deductions are allowed if the education is required to meet the minimum education standards for your job. For example, state licenses for hairdressers, teachers, or CPAs are not deductible. Although logically you would think that required education would be deductible, the deduction only applies to optional job-related education. You must subtract from your deduction any reimbursements you received from your employer. If you spent, for instance, $500 on job-related education and your employer reimbursed you $100, the balance of $400 is deductible. All job-related expenses work exactly the same way.
Strategy 5-51, deduct a home office when used for your employer.
You may take tax deductions for an office in your home where you do job-related work, provided the office is your principal office and you have an area set aside that you use regularly and exclusively for your employer's benefit. Even supplies, equipment, or furniture you use in your home office become deductible. If you own your own home, you may use the depreciation rules to deduct some of your home office expenses. If you rent, you can deduct a portion of your rent. In both cases, you may deduct a portion of your utilities, maintenance, improvements, and even your telephone and other expenses. Under Section 143B and C of tax reform, you can no longer take a tax deduction for renting your home to your employer. Used to be a great strategy. You now take all employee business expense deductions as a miscellaneous itemized deduction on Schedule A.
Strategy 5-52, pay your spouse or kids to help with your job.
If your spouse or kids can help you with the work you do at home for your employer, you can create immediate, legitimate tax deductions. Your spouse could receive an IRA qualifying salary for typing, answering the phone, or preparing reports. Your children might be paid a tax-deductible salary for stuffing envelopes, filing papers, or answering the phone for your employment-related duties.
Strategy 5-53, deduct your job-related tools and equipment.
If your job requires special tools or equipment, and you are required by your employer to furnish these items at your expense, you may deduct the cost. Examples of workers requiring special tools include mechanics, construction workers, nurses or other medical professionals, and repair people.
Strategy 5-54, deduct your special clothes.
If you pay for special clothing or uniforms required for your job, and the clothing would not normally be suitable for daily wear, the cost of the clothing is tax deductible. For instance, the special gold jackets worn by all Century 21 real estate people would qualify for a tax deduction.
Strategy 5-55, use Form 2106 to calculate your employee business expenses.
Whether you travel to make sales, sit behind a desk, or run equipment, Form 2106 is your ticket to computing all of your non-reimbursed job-related expenses. First, list your employee business expenses on Form 2106 and then transfer the total to Schedule A, miscellaneous itemized deductions. Let's take a look at a typical example. Rob Walters is an assistant manager for a small parts company. Seems to be constantly spending his own money on behalf of his company, maybe like you, but he never gets totally reimbursed. He stops every evening on his way home to deposit the day's mail at the post office. He should receive a deduction for 4 miles a day times 250 days, or 1,000 miles a year. Incidental mileage for errands for his boss adds another 400 miles per year. For 6 months, he supplemented his income with a second job. He drove 15 miles a day for 100 days, or a total of an extra 1,500 miles. The company purchased a new computer system during the year, and Rob took 2 night school courses to learn how to operate the system better. Now, Rob's boss said that they were necessary courses, but the boss didn't feel the company could afford the tuition. So Rob spent $275 of his own money on tuition, books, and supplies, and added on another 300 driving miles, all totally deductible. Rob spent $84 of his own money on job-related books and magazines and $60 on a portable calculator. He paid his kids $400 during the year to sort and file, all tax deductible. Now let's look at Rob's tax form 2106 and see how he takes the deductions. Automobile deduction, $720. Education books and his calculator, $419. Salary to his kids, $400. His total deductions amount to $1,539.
Strategy 5-56. Lump together your employee business deductions with miscellaneous itemized deductions on Schedule A.
Under the new tax rules, the employee business expenses shown on Form 2106 are lumped together with other miscellaneous itemized deductions on Schedule A. The other miscellaneous itemized deductions includes things like union and professional dues, deductible office and home expenses, investment expenses and advice, tax preparation expenses and tax advice, and even appraisal fees for casualty losses or charitable contributions. Using our previous example, if Rob's employee business expenses are $1,539 and his other miscellaneous itemized deductions total $1,500, the total miscellaneous itemized deductions equal $3,039. Now let's say Rob's total income is $40,000, but his adjusted gross income is only $20,000. The total deductions of $3,039 have to be reduced by $400 because of the 2% floor. 2% of adjusted gross income must be subtracted from the total miscellaneous itemized deductions. Now, 2% of $20,000 is $400. The balance is 100% deductible. In our case, Rob is allowed a deduction of $2,639, which saves him about $880 in his 33% tax bracket. As you can see, employees do get significant deductions, but most never know enough to take them.
Strategy 5-57. To reduce the amount withheld from your paycheck, add withholding allowances.
How many times have you said, gee, if I just didn't have so much withheld from my paycheck? 3 out of 4 employees, including you, can get themselves a tax-free raise of $50 to $300 per month by reducing the amount withheld from their paychecks. The amount withheld each payday is controlled by an artificial, little understood unit called the withholding allowance. By federal law, you must complete a W-4 form for your employer when you are first employed and whenever your tax situation changes. You and not your employer are responsible for determining how much is withheld from your paycheck. On the W-4 form, called the Employee's Withholding Exemption Certificate, you claim a number of allowances, usually ranging from 0 to 15. Theoretically, if you claim 0 allowances, an amount is withheld from your paycheck that by the year's end would equal the tax you would owe if you had 0 exemptions or dependents, including yourself. Each allowance you claim on the W-4 form will reduce your income tax withholding each year by about the same number of dollars you would save in taxes if you had an additional $2,000 tax deduction. The actual amount of money withheld per allowance varies slightly according to your income. If you add allowances to your W-4 form, your paycheck gets bigger. If you reduce the number of allowances on your W-4 form, your paycheck gets smaller. A personal exemption is not the same as an allowance. Claiming allowances is done on the W-4 form. Exemptions are claimed on your 1040 tax return. Many people incorrectly believe that you are allowed to claim only 1 allowance for each dependent in your family. Each dependent is worth 1 allowance, but you may also claim extra allowances for other tax deductions you already have or can create using tax strategies. Your objective is to get the maximum number of dollars legally possible in every paycheck. By adjusting the number of allowances on your W-4 form based on the following 2 formulas, you will be able to maximize your take-home pay. Let's look at what we could call the W-4 allowance rules. You may legally add any number of allowances to your W-4 form that will enable you to break even with the IRS when you file your tax return. That means you won't owe the IRS won't owe you. The number of allowances you may claim has little to do with the number of dependents you have and everything to do with the amount of tax deductions you can expect to claim by the end of the year. You and/or your working spouse may increase or decrease the number of withholding allowances you claim by completing a new W-4 form in the payroll department or personnel department where you work. Your employer has the form, or you may obtain a copy from the IRS. Your current W-4 form always remains in effect until you make a change. If you claim more than 9 allowances, your employer is required to send a copy of the form to the IRS. If the IRS can't understand why your taxes will be so low, they may send you a form letter asking you to explain within 30 days why you are claiming so many allowances. If you do not respond, the IRS will ask your employer to reduce your withholding allowances to 1 until you do explain. You are allowed, however, to claim more than 9 allowances if you deserve them.